All right. Good evening, everybody. I am Ben Suttles. I am one of the co-founders of Disrupt Equity, and I am going to be your host tonight, along with our co-hosts, Mr. Ronnie Phillip, Anton Matley, and John Montero from the DFW Multifamily Masters. So wanted to thank everybody for joining us tonight. Even though this is a multifamily masters meetup, we like all investments, right? So we've asked the Spartan Investment Group folks, Mr. Ryan Gibson, to kind of come on and tell us a little bit about self-storage and what they're up to. And, maybe it's something that we can diversify into, right? So, a little bit of background for folks that don't know me. As I mentioned, I'm co-founder of Disrupt Equity. We also have our own property management company. It's called Disrupt Management. We are also partners with several other firms that, offer some value-add services here in this industry. And, one of those is Peak Financing, Mr. Anton Matley, who will introduce himself here in a minute, as well as Strategic Insurance Group. And we insure multifamily, as is the namesake, right? So we are excited to be hosting this tonight. My co-host, Mr. Ferris, is out of the country. I don't know if he was going to join us. It's probably 4 a.m. where he's at, so I doubt it. But I'm going to go ahead and let our co-hosts introduce themselves. And then I think everybody's ultimately on, not to hear us talk, but to ultimately hear Mr. Ryan Gibson talk about self-storage. So, because Mr. Ronnie and his beard are so strong, I'm gonna let him kick us off, man. Why don't you introduce yourself, and then we'll go to Anton, and then we'll go to John. And you're on mute, buddy. Let's see if I can unmute everybody. Sorry, buddy. Hold on. See, this is why I have my co-host do all the technical stuff. I was really only here just to sell IT. He was actually the one making it work. Asked on mute. Sorry, give me a second here, everybody. Unmute participants. And if anybody knows how this works, you can certainly drop me a chat. Let's see if I can figure this out. Asked on mute. Asked to.
You got it.
Got it. Look at that, man. All right. I'm going to go ahead and get you unmuted too, Ryan, so I don't fumble my way through this whole thing. All right. Ronnie, you want to kick us off, buddy?
Yeah. So my name is Ronnie Phillip. I'm with the Kingley Group. We're a real estate private equity firm based in Dallas, Texas. We focus on Class A and B multifamily across the Sun Belt region, and really interested in self-storage. So looking forward to hearing more from Ryan with Spartan Investment Group. Love the self-storage industry. There's a lot of similarities and some differences, so definitely want to take some notes. Appreciate everyone being on here, and I'll go ahead and pass it off to Anton.
Hi, everyone. Thanks for organizing it, Ben, as always, and looking forward to hear Ryan talking about self-storage. My name is Anton Matley, co-founder and CEO of Peak Financing. We are a debt broker focusing on commercial real estate only. A big chunk of what we are doing is multifamily, but we also arrange financing for other commercial real estate, including self-storage, but also retail, office buildings, and even hospitality now has come back. So there are some lenders that are willing to do that. So if anyone has any questions, always happy to answer. And I passed baton on to John.
Good evening. Thanks, Anton. My name is John Montero. I'm based here in the DFW area in Frisco, Texas. Moved here in 2009, and since then been doing full-time real estate, primarily focused on the multifamily space. I am a lead sponsor and co-sponsor in 5,800 Doors, in multifamily, all in Texas. We focus primarily on San Antonio, DFW, Houston, and if I can find a deal in Austin, that would be great. Also do some new construction stuff, partnered up with the Disrupt guys on 300 units that we're building in Katy, Texas, down in the Houston suburbs. And I too am excited to learn about this self-storage space. You know, it's all about cash flow, right? So look forward to learning about that sector from Ryan.
Awesome. Awesome, guys. Well, hey, I appreciate everybody doing a little bit of an introduction. You know, Ryan, we appreciate you coming on. I know we had talked with Scott as well. I think he got jammed up on a flight, but you've been out to our conferences as well. We really are looking forward to hearing from you. So I don't want to steal your thunder. So I'll let you go ahead and introduce yourself. Tell us, you know, a little bit about yourself. Tell us a little bit about Spartan as well. And then, you know, I don't know if you have a presentation or if you just want to kind of go through. I'd say the one thing for everybody that's probably the most valuable is the Q&A section. So let's definitely, you know, stay around for that. And then ultimately for everybody that's on too, we'll do some breakouts at the end, right? You know, probably at least another 20, 30 minutes worth of networking. Hopefully Ryan can stay around as well if he's still available. And, you know, we'll do that. So don't hop off at the end of his presentation if you guys would, because the networking and the relationship piece is one of the most important parts of this. So without further ado, because nobody wants to hear me talk all night, Mr. Ryan Gibson.
Thank you. Thank you. Appreciate you guys having me. Yeah, if you don't mind, I'll just jump right into, I'm actually going to do a case study tonight. And I'm really excited because I see there's some of the investors in this project. And it's kind of like a fun way to actually update everybody on how the project is doing. We're going to talk about a 4-property portfolio that we bought right in the heart of COVID last year. And it's right in your guys' backyard. It's in East Texas, specifically Tyler and Longview. So yeah, if you guys don't mind, I can just jump right into it.
Yeah, let's go ahead. And I don't know if you have a presentation or not, but you know,
I do.
If you do, I could, yeah, see if you could share the screen there.
Okay. Yeah, no problem here. Let's see. 2 here and
Boom. All right.
A nice river or something here.
Yep. See it.
So, yeah, my name is Ryan Gibson, Chief Investment Officer with Spartan Investment Group. I'll get into my intro a little bit later, but you know, what's interesting about self-storage, I think, is that there is more self-storage facilities than Burger King, McDonald's, and Starbucks locations combined. So I feel like it's worth mentioning that self-storage is extremely popular. And not only that, but it is, if you add in Pizza Hut and Wendy's and more fast food locations, there's still more self-storage than all those locations combined. And so I think Americans really love their self-storage, and we'll get into some of the uses for it this evening. But just a little bit about Spartan. We actually operate under the Free Up Storage national brand. So our investment company, syndication company, is under Spartan. We're headquartered in Golden, Colorado and Seattle, Washington. And we operate our facilities and rebrand them into Free Up Storage. It's sort of like our customer facing brand. A couple of fun things. This past year, we were ranked the 5th fastest growing privately held real estate company in the United States by Inc. magazine. And we were ranked the 166th fastest growing company overall in the United States. A little bit about us. We've got about 12,000 units, 55 employees, about 340 assets under management, 400 active investors, about 120 million private equity raised. And we've got about 20 projects or 27 facilities currently, but we've had 10 that have gone kind of full cycle, mostly in residential. You know, where we got started, that's me on the left-hand side. I was previously an airline pilot for Alaska Airlines. It's me in a 737 holding my daughter on her way out to Hawaii, actually, on one of her first flights. And that's Scott Lewis, our CEO. Sorry he couldn't make it. He got stuck on a flight going out to Newport, Rhode Island today. But here I am. I'm actually in Vegas today at the self-storage conference. And that house in the middle is actually the very first house that Scott and I flipped. And the way we met was he lived in the house on the right-hand side, and I lived in the house on the left-hand side. And we met as neighbors. So people were like, how did you meet your business partner? It's like, well, he just kind of moved in next door. And then we got together. We had a very strong entrepreneurial mindset. And we were like, why is this house in Washington, D.C. abandoned? in such a, changing neighborhood. And so we looked up the owner and figured out how to get that property, that title into our possession and flip the house. And so that was the first Spartan project. It started in Washington, D.C. in 2013. And we've really kind of, our mission is to improve lives through real estate, giving the best opportunities to our investors, our sellers, anybody we do business with. But really, what we really stand behind is our values. We really harp on this to our team, and that's invest in our values, which is the acronym GRIT. And the GRIT stands for growth, respect, integrity, and transparency, and tenacity, which is instilled in all of our team members at Spartan. So Scott's an Army guy. He served in the military. He's still in the Guard in Colorado, and is a veteran of Iraqi freedom. So, all right. So we're vertically integrated. Scott and I are very hands-on. We do everything from the acquisitions to the capital markets. We internally and externally source all of our debt servicing on the properties. We syndicate, and we do construction. So top right there is Aaron Saunders, Director of Construction. We have a team of about 7 or 8 people right now and growing. We hope to have 18 employees in our construction team by the end of the year. So we actually build our own units in-house, and we do our own asset management and property management. So we basically take the property through all its phases. We find it. Sometimes we build them from the ground up. Sometimes we add on existing facilities. Probably 90% of the time we're buying an existing property and adding on to it. But sometimes we build new ones. And right now we're actually breaking ground on one up there on the top left of the screen, just south of the Washington state border. We're breaking ground this week on a project in Sandy, Oregon, where we're building about 50,000 square feet or about 350 units. The facility just north of that, top left-hand corner, is in just outside of Seattle, Washington. We just built 755 units, about 110,000 square foot facility, and just opened that back in June. So we do development. Obviously, you can look at the map and see that we're heavily focused on self-storage, that you can see the free up locations across the United States. We've done some random things like buy RV parks in West Texas and the Permian, which did great up until about COVID hit. And we're hopeful for recovery in the West Texas region as travel gets back to on schedule. We also uniquely built a brand new manufactured housing community up there on the top left-hand side of the screen. It's one of the first manufactured housing communities built in the United States in the last 5 years outside of the states of Texas, Arizona, and Florida. And it was just kind of a unique entitlement opportunity that we had. And we took 38 acres and built 217 manufactured housing community lots. And for those that aren't in the industry, it's effectively, we built a mobile home park in one of the most beautiful seaside communities in Washington. So it's very, very rare to do something like that. But our focus is storage. This is kind of our footprint in Texas. We're actually under contract to buy 18 self-storage facilities surrounding the DFW and East Texas region. So we have a pretty large footprint in Texas. We'll talk about the portfolio that we have in East Texas currently, and we've owned for a year tonight. But I wanted to talk a little bit about storage. So, for all those that know the Marie Kondo show, it's a show about Americans letting go of the stuff that they don't use, right? So it's imagine a reality TV show that's dedicated to people getting rid of stuff, right? Crying and really sad to get rid of things that they don't really use. They don't bring them joy, right? So as Marie Kondo says, if it doesn't spark joy, put it in self-storage on auto pay. That's realistically what a lot of Americans do. But we're going to talk about some other uses of self-storage tonight as well. It's about a $39 billion industry. We've got about 1.7 square feet or 1.7 billion square feet of rentable space. There's about 60,000 facilities nationwide, which there's probably about 60,000 multifamily complexes in the surrounding Dallas-Fort Worth area. So if you can imagine, there's really not a whole lot of self-storages when you compare it to other asset class types. 5.4 average square feet per person. So I see there's about 100 people or more on this webinar tonight. So what that means is nationwide, the average utilization of self-storage is about 5.4 square feet. So in the 100-person room that we're in, that means there's about 540 square feet of demand. on the national average, right? So that's basically what that means. And that's different. In Texas, it can be as high as 20 because there's no basements in Texas and the attics get a lot of humidity. So there's a lot of self-storage utilization in the state of Texas. And there might be a lot less in, say, the state of Indiana, where there's basements and there's not as much humidity issues in attics, right? So that number might float down to maybe 7 square feet per person. About 10% of households use self-storage, and the average rent per unit is about $87. Little bit of fun industry consolidation stuff. The industry, the money that's pouring into self-storage right now is incredible. Blackstone bought Simply Self-Storage and all their underlying assets, their brand, and all their store locations in Q4 of 2020, and they paid $1.2 billion. And I think the cap rate was probably in the 3s or 4% range. So they really paid a compressed cap rate for the opportunity to buy existing self-storage facilities that were stabilized. And, we built the Free Up brand so that we could build $1 billion portfolio and do something similar at some point. In Q4, Bill Gates also jumped into the game and bought a quarter share of StoreMart, which is one of the largest self-storage operators in the United States. And the hits keep just coming. In Q2 of 2021, Public went on a buying spree and bought up Easy Storage for $1.8 billion. So the industry is rapidly consolidating, and there's no time better than now. If you can get your hands on portfolios and opportunities, there's really a lot of tailwind and money pouring into the storage business today. But why did we get into it? So Scott and I were doing residential development. We were building new condos and houses and flipping houses and things like that. But we were concerned in 2015 about the housing market crashing. And obviously that hasn't happened for the past 7 years. But, we thought that we looked at the market and said, how can we protect our downside? What's going to happen during the next couple of recessions that would really, be recession resistant? And self-storage was really the standout. And it was really one of the least foreclosed upon asset classes in the last 2 recessions, mostly because it depends on life events. People rent storage because life happens. In COVID, we had record lease up. We had record rental rate increases because there was a lot of life events happening. Unfortunately, we were riddled with a pandemic, job relocations, moves, a flight to the suburbs, et cetera, that really drove a lot of self-storage uses. We also looked in 2016 at, how was self-storage doing and as a REIT compared to all other REITs. And we looked at the market and we said, the self-storage REITs are outperforming every other real estate REIT and the S&P 500 by more than 300%. And so we thought, geez, it does well in good times and it does really well in bad times. So it's kind of an uncorrelated asset class when it comes to the stock market. So we really like that as well. And COVID performance, these just came out by Yardi Matrix, these statistics. There was 12.7% rent growth year over year, which was great. If you're an owner of storage, you saw your rents go up, you saw your occupancy go up. And, in our pro formas, we only usually underwrite 1, maybe 1.5% at most in market rent increases over, a 5-year projection. And so to see the rents grow more than our entire business plan calling for in 1 year during a national pandemic, that was pretty incredible. Dallas, Fort Worth saw rent increases by 12% in climate controlled units. That's what that CC means. It means climate controlled. The Atlanta Metro, we're kind of both heavily invested in these 2 markets, saw non-climate control grow 16% and climate control grow 19%. Seattle, we're there too. Kind of was a little bit of one on the bottom of the higher rent growth, but still an impressive 7% year over year for non-climate and 5% for climate. So I'm a passive investor in multifamily. I love multifamily. I think it's a great asset class. I like this slide, not to pick on multifamily or single family flipping or anything like that. So, but I just like to do this slide just to kind of give a comparison. We all love real estate because it's tax advantaged and passive income and wealth building, and that's great. And I think self-storage, it's tax advantaged. We can take advantage of bonus depreciation and cost segregation and all the rest. The average stay, our portfolio is about 48-month average stay. Multifamily has great average stay. Probably depends on the market and the asset class type and things like that. Single family, same thing. Economies of scale. I mean, building a huge rental portfolio for single families is very difficult. For multifamilies, you get a lot of door under the same roof, right? We really like that. Same with storage. But really just some of the things that kind of stand out in self-storage are the automation. We could have a customer come to our facility, pull out their smartphone, book a unit, pay for it, sign a lease, and move in without talking to anybody. So automation is incredible. When somebody doesn't pay, their gate code gets locked automatically after 3 days of non-payment. And, it really is a big deal. Imagine just the deadbolt turning on your multifamily door after 3 days of non-payment. You'd probably end up in the news and maybe even in jail. But self-storage, it's something that is very highly automated, and all of our facilities have a high level of automation on them, which is great. Rent recapture. So the first paragraph block on a self-storage lease says something that's pretty interesting. It says, if you don't pay, the landlord has the right to lien your belongings. So we effectively have collateral against our tenants when they sign up. So we can actually, if they don't pay, we can file a lien, and within 30 days, we can auction off their belongings. And the proceeds from that auction actually benefit us, and we collect all the back rent, and then any additional profit goes to the customer. But we can get our unit back without having to go through an eviction. And usually we can have the tenant out within 30 to 60 days, which is great. And then low maintenance. We're not 12,000 doors. I think we have about 50 toilets. So if you had 12,000 doors, as John mentioned, he's in 5,600 units. I mean, that's probably about 12,000 toilets. That's a lot of toilets, right? So we like the fact that there's low maintenance, there's low variability in CapEx. We have a box, right? And some walls and a standing seam roof and a slab on grade. There is nothing inside the units. So how do you add value to that? So we'll talk about that tonight as well. We just had we had facilities that we raise rents on. Usually we get in, we raise our rents pretty much right away because we're finding self-storage facilities that have under market value rents. And then as soon as we take over, we raise the rents, and we add ancillary revenue streams to our facility as well. And I'll talk about what ones those are in a minute. But is it really worth moving? When I had a single family home in Cleveland, I always stressed about raising the rents because is the tenant going to find something else and move? And, is it really worth coming to a facility, moving out all of your stuff, getting a rental truck, finding another location for $10 a month? And the tenant might ask, well, am I going to get a better deal anywhere else? If I call the next competitor, they might charge more. So I'm really just kind of stuck with what I have, and I'm stuck with the $10 rent. So usually we come in and we raise rents, and we see only about 5 to 7% turnover, especially if they're under market value. So some ways that we make money, we deploy tenant insurance. So I like that picture. I love those commercials. Mayhem is everywhere. We require all of our customers to have tenant insurance. So they don't have to use our provider, but they have to be insured. So one of our metrics at our company that we measure is how many of our tenants are insured, because that's a revenue source potential for us. If the tenant uses our provider, we use Bader, then we get a 50% revenue share. So if you imagine 1,000 units, all paying $10 a month, we instantly add $5 a month in tenant insurance for literally no cost. Over 1,000 doors. We sell merchandise. We use excess land to rent a vehicle and RV storage. We do auctions. We do PO boxes in the office. We do notary services, FedEx and UPS drop. This picture is hot off the press. This is actually a truck that we're putting into service to rent. It's an incentive to actually use the truck for free. So if you rent a unit, you get a couple hours with the truck for free. But if you want to use it, kind of after that, there's a fee associated with it. We also partner with U-Haul. We don't do any maintenance on the U-Haul trucks or anything like that. It's literally a ground lease, and they just do a revenue share of the profit. And then lastly, cell phone towers. So the Tyler Longview portfolio that we're talking about this evening has a cell phone tower on it. What we do is we put our name on the National Registry for self-storage. So whenever we buy a property, we register the property saying, hey, we'll take a cell phone tower if you're looking for one in this area. And then we do a triple net lease for the cell phone towers. So what do we look for? We want expansion facilities or ground up development. So the picture on the bottom right there is a facility that we just recently built in Seattle. And the facility top right there is in a town that you might be familiar with in Texas. It's in Corsicana. It came with 11 buildings existing, in-place cash flow, and then that little orange box there was 2 acres where we could actually add on more units. But if you take away anything tonight, just remember that before you do anything in self-storage, buy a facility or especially build one, make sure you do a feasibility study in the demand, population, saturation, pipeline properties coming through the business, in the pipeline process. Maybe there might be building permits coming up. Make sure you actually study the market to make sure that they're in the data to make sure that you're not going to have, you complete your business plan. And we have a full-time team that does that at Spartan. It's all they do is they look at the competitor information, they call other facilities, we look at data, we use Radius, we use CoStar, we use a lot of different things. I think our second biggest line item at Spartan is data, and we're heavily dependent on using that to do our market studies. Where we look, I know this may seem like we're scattered, but again, if you want to get the high quality deal flow, you've got to look across the country. You can't look in one market. There's just not enough property that trades in any given state to get the deal flow, to get the AUM that you want for being a portfolio builder. This property is basically the reason why we look in these markets, and we looked at all the MSAs across the United States and narrowed down the top markets for high population growth, strong rental rates that would support an expansion of the self-storage units, even with rising costs of construction, and where the net migration of population is going. And this is posted on our website if anybody wants to see it. Asset property management. Left-hand side of the screen is kind of some of the things that you would see in revenue. So we have things like credit card fees, lot cut fees, late fees, etc. And on the right-hand side of the screen, you can see that we have, some of the typical expenses you would come to expect in a pro forma underwriting file for self-storage. This is our acquisitions team. We have 4 people full-time. What they do is they look at lots of opportunities. We look at about, this is our 2020 statistics. We looked at 1,237 deals. We said no to pretty much all of them, except 24. We thought we were good enough to go to LOI. And then we bought 9 new assets in 2020. In 2021, we're going to have a banner year. We're actually on schedule to close 42 self-storage facilities in the year 2021, or about $250 million in new assets. So we look far and wide. There's a lot of garbage out there. There's a lot of overpriced stuff. There's a lot of saturated markets. So you want to be able to get through these quickly and make sure that you can complete your business plan. So tonight, we're going to talk about a real property that we bought almost a year ago. It was a 4-property portfolio. 2 of those facilities were in Longview, Texas, and 2 are in Tyler, Texas. And we found this deal through a broker, through a relationship that we had with a guy in the market. And those are the 4 properties. It's kind of interesting. The attic storage on the bottom there, that was actually added during our due diligence. The seller was just selling the 3, and we said, "Hey, do you own any more?" And he said, "Yeah, I own this other one." And we said, "Can we add that into the portfolio?" And he said, "Sure." And so we added that kind of late in the game, and the broker was happy because he got paid more commission, and we were happy because we got another property. So it's $8 million purchase price, $560,000 of NOI were in place, and we closed exactly a year ago. So kind of neat. And this is just a little quick video from Tyler, who's our acquisitions guy, on kind of how the overview went.
Today's featured property is a Tyler Longview portfolio, which represented Spartan's first portfolio purchase in 2020. We went under contract at the onset of COVID, and I never thought this would happen, but our team literally jumped in an RV and drove the 1,200 miles to Tyler, Texas. That's never been done before, and I never thought we would do that, but it really just shows our dedication and commitment to get the deal done. What I really loved about this property was when we initially went under contract, it was just 3 properties. But after review and a good market study, we included the seller's 4th property, which increased commissions to the broker and also helped the seller achieve his maximum net proceeds. We're excited about this first portfolio, and we're looking for more portfolios here in 2021 and moving forward. If you have a lead on one, drop me a comment, send me a message, shoot me an email. We'd love to work with you.
So again, it was right in the middle of COVID and nobody knew what was going on. So like Tyler said, it was kind of fun. We all jumped in an RV for our due diligence trip and just drove to Texas. And it actually worked out pretty good. We kind of set up like a little mobile due diligence RV that we went in, and the team had a good time. So wanted to keep everybody safe. There was a lot of uncertainty during COVID, right when it kicked off. So good times. But what we loved about the opportunity was a cash flow day one. There wasn't a lot of REITs in the market, meaning we didn't have the intense competition that you get from like Extra Space, CubeSmart, Life Storage. It had a high occupancy, high physical occupancy. And the owner was out of state. He had his foot off the gas. He wasn't paying attention. I think there was 12 cats in one of the self-storage offices when we first bought it. The place was a mess. There was expansion potential, so we could actually add on additional units, and the market study that we did supported it. And we love the economies of scale. We could reduce payroll over time and put a regional in place to really drive NOI and valuation. So how do we finance it? Well, we found a life insurance company that gave us $5.7 million in debt. We raised additional funds for construction, and our equity investors invested $4 million. So we did a private placement syndication of 506C, and we raised $4 million. So that was $11 million. To get that done. $8 million went to the purchase price, $1.3 million went to expand the facilities, and $1 million went into just initial improvements. This is like roofs, drive aisles, painting, doors, cameras, gates, all the things that make our customers feel like it's a high quality facility. $300,000 for rainy day operating reserves. This is not a contingency on construction. This is just just sit in the bank account and do absolutely nothing with it. And there was $400,000 in fees. This is property management, acquisition fees, developer fees, etc. And the financing side, the equity basically came from our private investor network. I'm sure a lot of people are familiar with that on this call. We set up a 7% preferred return. It projected a 17.9% target annual return, and it was a 5-year hold. The construction debt, we also raise private debt through our investor network. We pay 1% closing point for all of our debt, and they get 7% per annum paid monthly. And then on the life insurance loan, we went through a company called Stancor out of Portland, and they leveraged it 57% on total project cost at a 3.75% interest rate and at 25-year amortization. So the first thing we did, we studied Tyler, we studied Longview, and we said, hey, how does our rent on our subject facilities compare to the other properties? Because we want to raise rents on people, right? We want to drive NOI and increase the value. So if you look at here on the right-hand side, the attic is what we bought, and Highway 155 on the left-hand side here is what we bought. And you can see that, you know, the Class A market's way up there in Tyler, right? And this is actually even increased further. But the Class B market, we're never going to make those properties a Class A property. You have to throw a lot of good dollars after bad. So we only compared our rents to the Class B market, and we saw that there was a gap, a huge gap, and an opportunity to increase rents by as much as 37% on Highway 155 and 8% on the attic. And similarly, in Longview, we did the same thing. We did a market rate study on the surrounding properties, and we saw that there was a 25 and 21% respectively opportunity to increase rents. We looked at physical occupancy by studying all the competition. In Longview, our portfolio was 90.4% occupied, and the market was 95% occupied, representing that there was good, strong demand in that market. Then Tyler, our 2 properties were 91.5, and the market occupancy was 92%. Again, strong market occupancy. Current today, this is a little dated. Back in April, it was 81%. I believe our portfolio occupancy is somewhere around 85 or 90% at this point. And then we did a feasibility study, and we went property by property, and we looked at the current and projected population, the current square footage, and the estimated demand. And you can see at the bottom, you can see the green represents, that's how much surplus demand was in those markets around those properties. And the red on the Highway 155 had negative demand. That's okay, because we weren't expanding that property, and it was mostly full at the time. So sometimes you're not going to see a positive demand. This is just sort of a best guess with data. But overall, we loved the demand of the property, especially at the attic in Tyler, where there was 172,000 square feet of surplus that we could have added. We looked at the population growth. Obviously, everybody knows Texas, very good, and employment numbers. We love seeing that 1% to 2% annualized growth in every market that we go in. So we put this property under contract. So what were the terms? $8 million purchase price, 42-day due diligence period, and we put up $75,000 of earnest money deposit that became non-refundable at the sign off of due diligence. During due diligence, we discovered 90% occupied, 17% of our customers were delinquent, 36% on the average below collection. So that's not where the rents were going. It was just, if you added up all the below market rents and all the delinquent customers, we had a 36% increase potential in rents. The market was 90+% occupied, and we saw that there was an opportunity to increase NOI on this portfolio by $400,000. And that would increase at a 6.9% cap rate, a $6 million value in the portfolio. We also found failing roofs, outdated retail offices with lots of cats, old swing doors on properties that nobody likes in Texas because they blow in the wind. The roll-up doors is much more preferred, and faulty drive aisles. And just overall, we found vacant land to expand that we had matter of right. And we calculated with our construction team that we're going to need about $1 million on the day that we close to make these properties to the free up storage national brand standards. We also go through the rent roll, and there's the rent roll. We're not going to go through that, but we looked at the rent roll and we said, okay, like I said earlier, there's over a $400,000 gap. But basically what we did was we looked at the rent roll and we said, okay, based on what they're marketing the facility to charge versus what they're actually collecting, there was a $447,410 gap in what they could have been charging. So the owner, again, California owner, out of state, not paying attention, gifted the properties, doesn't care, low cost basis, not really trying to push the needle, right? So really represented an opportunity to come in here and add value to these properties. Looked at the vacant land, and it was kind of fun. The portfolio actually included 3 vacant parcels, one at the attic, one at Gilmer Road, and one at Metro. So if you look at the bottom right, that's the property. You can see those little squares there and rectangles. That's actually the layout of a property that we're going to break ground on in the coming weeks. Actually, we're just starting that expansion. The other vacant parcels, we just said, they're there, they're good parcels. We don't know what we're going to do with those parcels. We don't have time. We've got to close this great opportunity. We're just going to leave that as additional upside to the investors in the deal. So we put no value on those parcels. The reality is we're probably going to build a 40,000 square foot building at the attic. We're going to add on to that, which is going to be a nice value. And at Gilmer Road, we're still kind of deciding what we're going to do with that land. So we plan the expansion at Metro. We're going to put 25,000 square feet of additional expansion. We have about $1.3 million in construction budget. That's about $52 a foot. That's pretty typical for Texas construction. It might be closer to 60 now with the prices of increase in steel. We plan a 6-month build timeline, and then we're giving ourselves plenty of time in the pro forma to lease it up. So 20 months of lease up time. So effectively, we're giving ourselves 2 years to build those units and lease them up. That would increase our NOI $108,000 a year, and that would add about $1.7 million of value. So underwriting summary, we conservatively underwrote raising collections $403,000, and we gave ourselves 5 years to do it. You don't just go in there and just do everything day one, right? You've got to give yourself time to increase your collections. And we underwrote expanding a worsening cap rate. So I know this is unpopular, but on all of our pro formas, our cap rates go up. So people ask, what do you think is going to happen to cap rates in storage? I don't know, but the way that we position our underwriting to investors is every single month in our underwriting pro forma, we show the cap rate increasing and getting worse. So it's kind of fun. I'll talk about, where I think the cap rate is on this portfolio now, but we showed a 6.9% exit cap rate. Didn't put any value on the parcels. And we planned a 25,000 square foot expansion at the Metro. And we planned for heavy customer friction. We're going to get in there and just make we're in the middle of COVID. So we showed economic occupancy significantly decreasing and just a lot of turnover of customers. We're going to get in there. We don't accept cash. That's not a way to automate a property by accepting cash. There's a lot of things that we do that kind of disrupt the customers. And we projected a 5-year hold. Taxes and depreciation, investors get a K1, usually losses in year one due to depreciation. This one had about a $10,000 loss in the year one per 50K invested, which is kind of on the lower end of things for us. Usually it's usually 18 to 19,000. And obviously recapture upon sale. We won't go into depreciation on this. It's, I think everybody kind of knows this. And $50,000, $10,000 loss. We have a cash in hand loss on paper. This is how it kind of works though. They allocated $800,000 to the land. They put about $644,000 of that into 5-year property. They put $922,000 into 15-year property, and then the rest goes into 39-year property. So you've never really seen a cost segregation study break out. That's kind of the highlights, is they put it in those 4 buckets. And then they say, okay, your total purchase was 8 million. So we're going to give you these 2 numbers here as a loss in the first year. So that's a $1.5 million loss by taking bonus depreciation. So you can actually write off those losses in the first year. But you can also take the 39-year, right? You have to divide that by 39, and you also get the 39-year property every year. So $144,000 loss to the partnership every year for depreciation. So basically, year one depreciation on this portfolio was about 1.7 million. So here's the fun part. So the portfolio is going exceptionally well. And all of a sudden, our broker brings us another deal in Longview. And it's like right kind of by the other 2 properties. And it's called I-20 Storage. And so we were like, okay, we could syndicate the equity, kind of do this as a standalone deal. Or maybe we figure out a creative way to put this property into the Tyler Longview portfolio that benefits our existing investors. More economies of scale. We don't have to add any additional payroll, et cetera. So it was 45% occupied, very poorly operated. We had our regional manager for the Tyler Longview portfolio go over there and verify that. We did a due diligence trip with our capital projects team, et cetera. And the market was full. And this property is 45%. I think it actually was like 39% when we took it over. Vacant land for expansion. It's right on I-20, the freeway. And so there's 20,000 cars zipping by this every single day. And we saw the economies of scale and the opportunity to add another $182,000 at NOI to the portfolio. So we said, hey, this is a good deal. Value at stabilization, about 3.2 million. And so we looked at our financials and we said, the current portfolio, we're ahead $30,000 a month in our current projections, right? So we're thinking we have excess cash flow above and beyond what we projected. So how about we use the excess cash flow, raise 100% debt for this property and take it down. And that way the investors don't have to dilute any equity, and they're going to get a 5th property essentially for free. I mean, you have to pay for it, but we looked at our current loan to value is 57%, so quite low. And using debt to buy the 5th property, it would really only, using 100% debt, it would really only increase our total loan to cost to 66%. So very healthy leverage still on the portfolio to take that down. And so we raised the private debt as follows. I mean, these were our terms. We basically went to our investor network. We said, hey, we're buying this for 1.8. We need 2.2 because we put a new roof on this property and did some improvements to it, et cetera. We wanted some reserves, and we gave them a loan. And it was an interest-only loan, 14 months, 1 point at closing 7% per annum, and we pay them monthly. The first position on this asset, they got a deed of trust. So we're exceeding the performance by $30,000 a month. That additional loan cost us $12,833 a month. So we still were cash flowing even with that additional debt. It added about $182,000 a year of NOI, and it didn't require any dilution of capital from our investors. So we told our investors what we were up to. Hey, we're buying this additional asset, and the portfolio is performing well enough to consume it. So we bought it, and now the facility has 5 storage facilities in the portfolio. So initially started off as 4, and now is a 5 property portfolio with the I-20 self-storage facility coming in. and it makes our effective going in purchase price $9.8 million. So we talked about the capital stack earlier. So just kind of what we did. So we exit out the debt at the bottom. We increased the debt to $7.9 million. That brought our total project cost from $11 million to $13.2 million. Now our purchase price went up to 9.8. Improvements, we did about $200,000 of improvements at that property day one: cameras, lighting, roof, etc. And then our operating reserves, we increased by 100,000, and we took fees for that, right? Because we get our acquisition fee and our developer fee for doing for adding another property to the portfolio. So how do we underwrite a portfolio? You're probably wondering, in multifamily, we do a certain EGI, or expense to gross income ratio. On this particular portfolio, we underwrote it at 51.3 expense to income ratio. That's pretty high. And that gets better as your gross potential revenue increases, right? As you add on additional units, the whole portfolio gets efficient. We see that number come down into the mid 30s once we deploy our efficiency on that. But right out of the gates, we're underwriting about a 51% expense to gross income ratio. That means that for every dollar we earn, we spend 51 cents in expenses. We underwrote the facilities only getting to a 91.42 max economic occupancy. We underwrote the 25,000 of expansion. The cap rate at disposition in 5 years, we put at 6.91%. In reality, it's probably 4% now. So you can do the math on that. It's pretty undervalued. And basically, this is kind of like current versus actual. And I know this presentation's a little bit dated, so it was done at month 8. But the portfolio came with $560,000 of NOI the day that we bought the property. And we were going to say, raise rents and increase to $403,000 at month 60, and add on. And we're not putting any value on the parcels. And so our business plan called for income of 1.071 million NOI and increasing the portfolio value to 15.5 million. That was our business plan. Cash flow along the way, so upside from the sale to our investors, exiting at a 6.91% cap rate. I think our going in cap rate was a little bit lower than that. Here's what's actually happening today. 560,000 NOI exists. We've actually increased our NOI already by 208,000 by month 8. I think it's a bit higher than that now. We are still doing the expansion at the Metro that kicks off soon. We still haven't sold those parcels or done anything with them yet. But now we've added that 5th property. So with that additional 183,000 of NOI from the I-20 acquisition, we're now looking at a 1.059 NOI projection, which again, I know we haven't completed all the rent increases yet, or about a $15.325 million valuation. In all reality, cap rates are probably in the high 4s for a portfolio that's trading, that's stabilized. We're looking at more likely a $20 million valuation with all the additional properties. So tracking business plan performance, we're getting here to the end. This is how we do it. We share with our investors pro forma versus actual, and we give them investor statements. So we show them the revenue, what it should have been in the dashed lines, and then we show our investors the solid line for how their performance does. And we share these quarterly with our investors. We do it for expenses, and then we do it based on distribution. So you can see here, we pro forma, we say, at the beginning of the business plan, we tell our investors, okay, this is how much money you can expect to earn every month. And then this is actually what we've been distributing. So as you can see, we've been blowing it out of the park, quite frankly. We've increased the rents a lot faster. We're implementing our business plan a lot quicker. And so our distributions are going much better than expected. We also do that for net ordinary income as well. So 5 property portfolio, one thing we like to do is we like to add value by implementing sophisticated operations. I love using the word sophisticated because sometimes it means like firing the angry manager or unlocking a gate sometimes, or getting rid of cats. Really, we just professionalize operations and we do things better to attract customers to the property. The other thing we like to do is, expand and improve existing facilities, which we did, which we're in motion for with the Tyler Longview portfolio. And overall, we are looking at portfolio deals almost exclusively now. We just bought a 10 property portfolio in Tennessee, Georgia, and Florida because we really like cutting payroll, reducing expenses, and getting the economies of scale within a given market. This is Ted, Lauren, and myself. We're on the investor relations team at Spartan, and that's all I have.
All right, Ryan. Hey, and I wanted to thank you. You worked it like a champ, even when somebody was drawing on your presentation, man. So,
I saw that. I was like, that's interesting.
Kudos to you, man. This is not your first.
Worries.
This is not your first rodeo, but
I have two kids at home, so I've got lots of distractions. I can.
There's always somebody that wants to mess around. So no, but we do appreciate it. Ultimately, it is what it is. But hey, great presentation, added a lot of value. Let me see. Somebody else is also trying to write on it. This is some fun times, but wanted to go ahead and open it up to any questions that anybody has, right? I mean, I certainly have a few. They kind of revolve around kind of differences in multifamily versus self-storage, because I think a lot of our audience is going to kind of maybe try to make those correlations between the two asset classes, right? So the one thing I wanted to go back was earlier in your presentation, you kind of had the table, what boxes checked for self-storage versus what boxes checked for multifamily. Can you talk to us a little bit about the maintenance? That was always the one thing that I loved about that asset class. And you really kind of hit it on the head where you're talking about, toilets versus, hey, I only got like 12 toilets in our whole portfolio versus you guys probably have like 12,000, right?
Yeah.
And, how do you manage that? You had mentioned something about a regional. Are you guys just doing it on a regional basis where maybe you have somebody in a specific location and then they're just traveling around? Can you kind of give us a little bit more perspective on the property management side of things?
Yeah, so we have a maintenance guy that does travel around to our properties again, which is why we love the portfolios. It's just easier to co-locate and manage that. But we do have we have maintenance personnel, we have store managers, and the store managers are responsible for a lot of our maintenance, but we also have vendors that service, and having our own in-house construction team, they really can work with subcontractors to have properties serviced properly. But there's not a lot of maintenance. A lot of the things that we do when we take over a property is we're all about protecting that building envelope. We put on gutters, we paint, we refresh the doors, we get that facility functioning. So there isn't a lot of maintenance later on. Coming from an airline background, I know everybody's like, oh, planes break all the time, but they really put those aircraft through, a high rigor of maintenance to prevent them from breaking a lot, right? So, what we like to do is take over an asset and get everything fixed up, get it all going to our standard, which really reduces the pains that come later. But yeah, we don't have water heaters or cabinets or appliances or toilets or any of those things that would require heavy maintenance. Typical things are like door springs, a roof might leak, or you might have somebody run into a bollard or the side of a building or something. That doesn't happen very often, but those are the types of things that we deal with, and it's not really that big of a deal.
Yep. No, love it. So second question, kind of along that same vein, from that same slide there. Talk to us about the automation. I think that's the other cool thing that self-storage has, at least right now over multifamily. I think there's some people that are trying to be a little bit bleeding edge and introduce more automation, and especially when it comes to the leasing process. But you guys are light years ahead of multifamily on that stuff. Can you kind of talk about some of the stuff where you're identifying, weak spots in automation and what you kind of implement and has the best return on investment?
A call center allows you to automate, an offsite call center that people can call at any time. 24-hour rentals on our website and 24-hour rentals that are available on a smartphone. Having the gate software integrated with your property management service. So if you pay, the gate knows it right away. That's a thing. Some people do the kiosks. We kind of feel like that's more of a nuisance than anything. I feel like everybody in the United States has a kiosk in their pocket, which is their smartphone. So anything that you can do there. We clearly depict when you pull up to our gate how you could book a unit without talking to anybody. So we kind of do the customer journey on the gate that shows, to book a unit, go to this website, dial this in and you can pay right away. But really, that's, I like to say that there's more sophistication to it, but that's kind of it.
Yeah.
Some of our properties, are monitored on our doors. You can see when doors open and close. You can see a lot more information, but not all of our properties have that.
Awesome, man. Well, hey, I'll give the mic up to a couple of the folks that have asked some questions here in the chat box. So,
Sure.
without further ado, I noticed that you don't have any California properties. Any reason?
Correct. We don't. I want to be nice.
No, come on. I mean,
Yeah,
I guess.
So we like areas where we can develop with ease. Washington is a pretty tough place to develop, and obviously Oregon too, but we have boots on the ground there to handle that. In California, we're just a little gun shy of adding on units and building there. And also, population loss is kind of population drivers are where we focus. We want to be in the states where the growth is. One thing that's unique about storage is we're not really, we can invest in Washington or Seattle and do really well. We don't have the rent control laws that multifamily has. We don't have moratoriums because, quite frankly, nobody cares about grandma's dresser, right? Yeah. They care about your housing, but they don't care about your stuff. So, we look in blue states and red states that have high growth. And because we can operate with ease in those markets, even if they're more favorable to the tenant, because of the laws and storage are very favorable to the landlord in every state. But California, we just don't focus on it due to that reason.
Gotcha. All right. So next question, when did you quit your full-time job, and do you still keep your full-time job?
So I'm not full-time anymore, but I love flying. So I've kept a very part-time status in the airlines, and currently work for Delta. So,
okay.
Yeah,
All right. So Mr. John Montero asks, how many on-site managers do you need for the 5 properties?
How many do we need on a daily basis? Is usually 3. I think we have 5 total employees currently, but we're reducing that.
Okay.
We're working on that now.
So is a lot of it just, kind of developing, a floater type sharing of assets type, process, that's the other thing that I think you guys have over multifamily. In a lot of ways, you have to have dedicated staff that sits there every day, because there's going to be people that are going to walk in that door. Right. Whereas I had a storage unit for like 5 years. I don't think I ever walked in there, from the time that I dropped my stuff off to the time I picked it up. And they had built-in rent escalators every single year that I just ate, because I was just like, I don't want to pick that stuff up. Right?
We're looking to cut staff 20% next year, and we're looking to get more regional managers that are higher paid, that are more engaged employees that oversee multiple facilities and can dedicate time to the problem facilities. But really, there's not a whole lot of need to have somebody sitting there renting a unit. Yeah. We are actually going to start implementing fees where if you come into the office and book, there's an inconvenience fee or a convenience fee of doing that. So
love it. So paying up for rock stars, right?
Exactly. Yeah, that's the only way to do it. Yeah,
absolutely. All right. So there's somebody pitching a deal. Is there a minimum square foot that you focus on?
We rather than square footage or number of units, we focus on revenue potential. So we like to see 300,000 gross potential revenue, because there could be a small facility that produces strong revenue because the rents are high. So we like to see a gross potential revenue of at least 300,000 annually.
Okay. All right. So it's more revenue driven versus square footage driven.
Yeah, correct.
Gotcha.
Yeah. And even on potential. So like if there's a potential to add on additional units, we'll like that.
Gotcha. So where do most experienced multifamily entrepreneurs fail when investing in storage units? I guess maybe to ask that question in a different way, maybe, for some of the folks that, want to hop over from multifamily and maybe do a self-storage deal.
Yeah, I think one thing, that's a great question. I get where that thing is going. So, you might move across town to rent a Class A multifamily and be in a good school district, right? And I'm kind of guessing here, right? So, I know that I would move my family to a specific location and pay for certain amenities at a property. That doesn't exist in storage. You are focused on a hyper local market You are focused on a 5 to 15 minute drive time around your property. 15 minutes if you're more rural and out in the country, 5 minutes if you're in a heavily congested city. The only demand that you have, it doesn't matter that Austin is a great market or Seattle or wherever. It is what's going on within the immediate micro market of your property. How much demand exists. Of course, you have to have the macroeconomics, growth to the city and stuff like that, but it's really dependent on that location. So you can have a really nice property in Denver on one side of town, you move to the other side of town, it's completely saturated, right? And you're like, well, Denver's a great market. Well, not right there, it isn't, not for storage, right? And I'm not talking about crime or anything like that. I'm talking about raw demand of square feet. So, really is micro dependent. So, I would just say, make sure you do a feasibility study with a self-storage provider that is familiar and does feasibility studies. One I gotcha is building permits in the pipeline. Leasing up a property when somebody else has just built a property is a big deal and can really set you back. So that's one thing. I think storage isn't complicated to build. It's different. And there's a lot of overbuilding that you can do, and there's a lot of underbuilding you can do in storage, right? You can oversimplify or you can overcomplicate. So I would really just recommend, making sure you go with a contractor that's done storage before, and ideally has done a lot of storage before. And what we do is we actually go to the vendors and interview the vendors and say, who are the construction contractors that are building and that you enjoy servicing, right? So that's why we go to the trade shows and we're very involved in the industry. It's a very micro industry. Multifamily investors tend to think that, man, multifamily is so overheated, there's no deals, or, and this storage, I never hear about storage. And the reason why you don't hear about it is because there's not a lot of it. But when you come over to storage, you'll realize it's just as bad over here as it is over in multifamily. It's probably worse. So, I think a lot of people think, oh, I'm just distracted or I can't get the deal flow I need in multifamily. Just know that it's a crowded space over here too. A lot of similarities, but it's a crowded space. And the last thing I'll say is be careful in the primary markets. Just be really careful. I mean, you buy a premium multifamily asset in a primary market, you're probably going to do pretty well. Self-storage, the REITs will eat your lunch. They have more money than you to spend on advertising. They will cut their rents and they'll ride you out a lot longer than you can stomach it. So just be really careful in the primary markets. There's a lot of saturation in primary markets, and I'm speaking in general terms, but we really like the tertiary and secondary markets because we don't have the REIT competition and we see a lot of bedroom communities really growing. So that's kind of a benefit. We love East Texas. It's a great market. A lot of income growth there and a lot of jobs moving that way. We love the bedroom communities surrounding DFW in the DFW metro area. Some growth there is better than, downtown, right? So I would just be really careful, and tertiary means a lot of things to a lot of different people. I mean, when I say tertiary, I mean, usually within 60 minutes of a major metro airport not like the middle of nowhere, New Mexico or something, right? So, I would just be really careful with that.
I feel you. All right. So we're going to do rapid fire here, Ryan, if you could bear with us here. We got probably about another 5-10 minutes, and then I wanted to do a breakout. So if you're starting small, is there a minimum number of square footage that you would recommend?
No, I don't have a minimum.
Okay. What is the minimum units needed to be able to hire a manager?
Focus on revenue. You probably want to see $20,000 a month of NOI.
Okay.
Don't focus on units. It's not about units.
Are there specific sizes that rent better than other sizes?
Given the market, there could be. Obviously, a 5x10. So 5x10, 10x10, generally, we're going to get the same price per square foot as multifamily in that same market. But some markets, as you get to like 10x30, that price per square foot starts losing its efficiency, right? Starts getting less per square foot.
Okay, so what's your take on trend on drive up versus
market dependent? If you're in downtown Seattle and you're building drive up, you're wasting land and you're not going to get efficiency. Somebody's going to go up an elevator in downtown Seattle. Drive up units in the country, in more rural markets, people love the drive up units. They don't want to go into a big building and go up 3 levels to put away their couch, right? They want to drive up to their door. Drive up units are the best units ever, right? Because you can drive up to them, unload your stuff. Maybe there's climate control component to it. But, in a downtown setting or urban market, you're not going to do that because it's not efficient, right? You want to stack.
Yep.
Building bingo, and a big rumor, big myth is building single story is actually a lot more expensive than building multi-story in storage. Because if you keep it under 3 levels, you don't have to deal with the fire code of the IBC of going 4 levels for the installation. And, you're putting in an elevator. It doesn't matter if it's going to 1 level or 3 levels. It's 3 levels up is efficient. You have 1 roof, you have the same amount of walls, and you have the same foundation. So really going multi-story is actually a bit more efficient, but the customers might not like your facility as much as a drive-up unit. All market dependent.
Gotcha. All right. While currently planned facilities can be taken into consideration, how do you account for new entrants down the road?
Yeah, you just have to be in a market that has, unmet demand. And, there's really, and you got to look at the barriers to entry. We built a facility in Seattle, took 4 years to permit. The one we're building outside of Portland took 5 years to permit. That's a pretty big barrier to entry. We just built a facility and added onto a facility in Conifer, Colorado. It's impossible to get permits in that market. So, we like markets that have high barrier to entry, but there's some markets that have low barrier to entry. And you just have to consider that in your business plan.
Gotcha. All right. Have you bought in, pal, you said food, I'm assuming flood zone. Would you not? Why? No? Okay.
You just don't.
Okay. Can you name any popular companies that conduct feasibility studies accepted by lenders?
Bob Copper and Self Storage Advisors, Jay Graham out of Boise.
Okay. And then I think there was one other question here. What's the underwriting process look like for storage, existing deals, expansion, and new development? I guess, I think you kind of walk through a little bit of that in your presentation as far as what you kind of look at,
Similar.
rent roll, financials, similar to multifamily.
Yeah. I mean, it's similar to multifamily. You do your unit mix, you do your expansion pro forma, you put in your assumptions for construction, et cetera. Do your sources and uses, your monthly P&L, your annual P&L, your exit tab. And it's very similar.
Love it. Hey, and last question, because I'm just curious about this. We had Brian Murray a few months back, and he talked about mobile home parks. And, it's very just sporadic in terms of, getting a third-party property management company to do mobile home parks, right? Talk to us about property management. I know obviously you guys have it in-house, right? But is there third-party property management companies that do storage?
Yeah. So
Okay.
most public storages and Extra Space and CubeSmart and StoreQuest, those REITs actually do private management.
Okay.
You do property management, but be careful because it's really just an acquisition strategy.
Oh, they're just what? They're waiting you out until you're ready to sell, or what?
Well, you know what Extra Space did during the pandemic, they cut their rates 50% at all of their store locations. Algorithm went out and none of the property owners had any control of it.
Oof.
We tried to buy one of those properties out of the pandemic because the owner was so frustrated. That was managed by Extra Space. So we came in and wrote an offer. We were just about to get the terms, and Extra Space said, "Wait a minute, you're selling that to those guys? Oh, we'll buy it tomorrow for $100,000 more." So they decreased the valuation of that property, waited for someone to come in to buy it, and then paid a little bit more, and because they knew that property could see better rents. So be really, really careful about third-party property management. They do not have your best interest. And I can tell you that because I have experience with it. So, property management companies are great. They care about one thing and one thing only: a percentage of revenue and buying your property at some point, because they own a lot of them. Public Storage is the largest owner of self-storages in the country. And an acquisition strategy is to put their branding on it and buy your property at some point. And, if they tell you that that's not the truth, it's ridiculous. I mean, that's what it is. So we built that capacity in-house because we're aligned with our investors and we're focused on the same thing, which is NOI. We want to increase NOI and increase the value of the property and sell it for as much as we possibly can.
Boom. Love it. And I agree 100%. You know, same feedback would be in the multifamily side. You know, third-party property management is a grind. And I don't know if they're necessarily out to buy your property, but most of the time their interests are not aligned. So take that for what it's worth, everybody. But once again, Ryan Gibson, Spartan Investment Group, we really, really appreciate you taking some time. That was a heck of a presentation, man, and a subject that I think a lot of us are interested in. So thank you for kind of condensing it down and also staying around and doing some of the Q&A. And I know some people were asking, hey, can you repeat the feasibility study? All of this is recorded, folks. We will send out the recording to everybody that's on the list. So wanted to go ahead. There's still 62 people that are on. Wanted to see if anybody wanted to do a breakout. You know, we'll probably do one breakout since we're running a little bit late on time. Ryan, you know, if you got to run, totally get it. You know, but if you could stay around, you know, we'll do a little bit of networking, and then we'll come back in maybe 10 or 15 minutes, and then probably call it a wrap. But
yeah, I've got about 5 minutes, and then I've got to run. But yeah, perfect.
Cool.
5 to 7 minutes. Yeah.
Awesome. Thanks, Ryan. We appreciate it. And let me go ahead and see if I can fumble my way through these breakouts. So bear with me here.
Good.